Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to talk about what the Palo Alto Network's earnings can teach public company investors. And it starts with this premise that a guidance miss or guidance reduction is equal to bad financial expectations management. And there's typically three drivers of why you're in this scenario. The first is management philosophy. The second is financial planning and analysis, or FP&A competency around people, process, and systems. And the third is consensus, and really that's bad financial expectations management. So let's drill down into each of these three drivers. Management philosophy is this idea that in software as a service or a recurring revenue business, the management team can kick decision making or kick the can down the road to the last day of the quarter. And what that does is that leads to very last minute decision making about changing guidance. With FP&A, there's four key issues. The first is not tying the actual guidance to the sales pipeline. The second is not adjusting for currency accurately. The third is not actively tracking the sales pipeline. And the fourth, and probably most important, is sales and finance may just hate each other's guts. And so that leads us to consensus. And with consensus, there are two issues that a company faces. Are they giving guidance that has no margin for error? And are they actually actively managing that guidance and expectations with investors? And a lot of times a company isn't, and that's why you end up with a guidance reduction. And that leads us to the idea of valuation. A premium valuation is driven by accelerating growth and accelerating margin expansion. If you adjust your guidance and trip up one of these two things, you're going to get a re-rating in the stock. And so the key three takeaways for management teams are this. If you change one of the magic drivers of a premium valuation, your stock is going down. Number two, the most important thing with earnings is guidance, nothing else. And number three, the higher the valuation of your stock, the higher the sensitivity to actual changes in your financial guidance. The smallest changes will drive very large changes in valuation. Thanks for watching. Always here to help with your capital markets, investor relations, and corporate finance needs.